In an efficient market, the pricing for something for sale is tight. In an inefficient market, the pricing for something is much more broad. We consider middle market and lower middle market mergers and acquisitions and capital markets to be relatively inefficient markets. And so in today's video, we wanted to discuss the difference or the distinction between efficient and inefficient markets, some examples of each. The way we would define an efficient market is a market in which price discovery is readily available and that the gap between the bid and the ask in a particular transaction is not very broad or wide. When we think of price discovery, we think of an example of an efficient market as the publicly traded stock markets, particularly the New York Stock Exchange and NASDAQ. If you go online and you see, hey, how much is a share of General Electric or Facebook or whatever, you're going to see that you can buy it for X dollars anytime between the hours of 9:30 and 4 o'clock on any weekday. If you look at cryptocurrencies, if you look at a lot of different assets, even if it may not be something that you invest in, you can at least understand the distinction of what's an efficient and inefficient market. So price discovery, how much is something worth? And so we think similarly, residential real estate. If you go on Zillow, there's a Z estimate. I'm not saying that's the gold standard of how much a home is worth, but it's discoverable pretty readily, and therefore it's a somewhat efficient market. And so when you go to the bid-ask spread for a particular asset, it's pretty narrow. If you go to a multi-billion-dollar large cap company in the publicly traded markets, the bid-ask is going to be a fraction of a cent. But that's the variance depending on how much you offer, so to speak. And most people wouldn't even think of that because you just go online and buy it for the price. And so when we think of the bid-ask spread in situations, we always like to say, how different would the price be if it was a represented versus an unrepresented situation? How different would the price be given a certain number of participants in the exercise? If you wanted to buy Facebook, yes, it matters that there's enough people selling Facebook for you to buy stock, but the banks have their own inventories. It's very efficient. And so the gap between what you're willing to pay and what's going to be there available is not going to be broad in that sense. Something more tangible and smaller ticket might be Rolex watches or Birkin bags. If you go online, you can very quickly decipher what people are offering for things, what people are selling things for, and what is that bid-ask spread. Now again, it's going to be wider than stocks, however, it's still going to be fairly efficient. And therefore, service providers that facilitate the sale of these types of assets are really facilitating the process, not so much the price discovery mechanism or the narrowing of the bid-ask offer to a tremendous degree. Now, in different types of assets, depending on how inefficient, they will be more important in those regards. And so now let's pivot over to inefficient markets. And so we would say those are markets where it's difficult to glean the price or the value of something, and also where the bid-ask spread is very broad. And so we would define the market that we work in every day, so middle market, lower middle market, mergers and acquisitions, and capital markets, as an inefficient space. We could bring the same company out to the market, and if we have 3 conversations, we could get a price of $1, $2, or $3. Not only that, but there's many other variables that bake into these transactions, like what's the structure of it? How much is that closing? How much is over time? What are the contingencies? What's the transition period for ownership look like? How do the stakeholders get taken care of in terms of the other employees, the brand, the legacy? And so when you're going to sell a business or go find capital for a business, not only are you going to get a broad deviation of offers, but you're also going to get a broad spectrum of data points relative to the other salient variables. And so that's why it's important to, A, get lots of variables or lots of data points. And so we want to run a process where we're not talking to 5 people, we're talking to 100 people. We don't want 3 offers, we want 30 offers. And obviously different situations will allow for different things, but the point being is the more data points you get in an inefficient market, the more you're able to extract what the true bid-ask is on something and discover what the real price is, or what an arm's length third party would be willing to buy a business for and under what terms. So this is not purely us selling our own book and trying to explain why it's so important to have representation when you pursue these things, but it's something to be aware of. Where a price for certain assets in efficient markets may deviate by a certain amount of percentage points if you were to try to sell them yourselves, in selling your business yourself or finding capital for your business yourself, that deviation of data points is going to be far broader, both relative to the price and also some of the other important characteristics. And so therefore, it's important. More data points, better price discovery, narrower gap between the bid and the ask. That allows us to create efficiencies in an otherwise inefficient market. And so that's the thought for today. Efficient versus inefficient markets. Hope the week's going well for everyone. Keep pushing forward. God bless. See everyone next time.